In this video, we're going to look at the opportunity of Maddox Resources offering a discount. And so when we do this, we're just doing an analysis to see what we can do with the extra cash that Maddox would have by changing its accounts receivable and freeing up some cash. We'll look at what that looks like when we invest the cash, and then also if there's any charges that need to be made by doing this new policy, we'll look at that as well. So I'm actually going to be answering part, I think it's part B. B and C. Okay, so let's read through this. Maddox Resources has credit sales of $180,000 yearly with credit terms of net 30 days, which is also the average collection period. Maddox does not offer a discount for early payment, so its customers take the full 30 days to pay. In Part B, it says, if Maddox offers a 2% discount for payment in 10 days, and every customer took advantage of the new terms, what would the new average receivables balance be? Use the full sales of $180,000 for your calculation of receivables. So we will do that, but let's look at C as well. If Maddox reduces its bank loans, which cost 12%, by the cash generated from reduced receivables, what will be the net gain or loss to the firm should it offer the discount? Okay, so this is how we're going to do the analysis. First of all, we need to start off with the old accounts receivable. Just make this a little bit bigger. Okay, so in order to get that, what I'm going to do is figure out how many days my sales are. So I'm just going to switch this yearly sales to daily sales. So if I do 180,000 and divide that by 365 days, that means my sales are about $4,932 a day. And if my accounts receivable are 30 days, so those are my terms. So I'll do 30 days. Then I can take the dollar sales, $49.32, and multiply that by 30. So 4,932 times 30. I think I put way too many zeros in here. Let me just take that away. Perfect. So I take 493 times 30. That gives me $14,795 for my accounts receivable. And I'll just hide the decimal places. So that's my old receivable. Now, my new accounts receivable can be calculated like this. So we already figured out that my daily sales are $493 per day. And again, I'll do the formula without putting in too many zeros. 180,000, 180,000, divided by 365 days, because there's 365 days in a year. So that's the 493. And to offer the discount, it says that I'm expecting my customers to pay me in 10 days. So I'll put this down to 10. So my new accounts receivable should be $493 times by 10 days. So instead of having $14,795 in accounts receivable, if I give the discount and all the customers pay me early, I'd only have $4,932. So I can take the difference. So I'll just take 14795 minus 4932, and this is the amount of cash that I'd free up. So instead of them being in accounts receivable, I would actually have cash because my customers are paying me early now. Now, if we use that cash and pay down our bank loan, so we're paying 12% on that, then what I want to calculate next is the interest that I wouldn't actually have to pay because I'm going to have that money now. So the interest rate is 12%. So if I take 9863 and multiply that by 12%, the amount of interest that I'll save is $1,184. So I'll just say interest saved. So if I can save $1,184 by offering the discount, right now I would say, yes, let's do it because it's above zero. But I'm also going to be giving a 2% discount off of the accounts receivable. So it says I'm going to offer 2% discount for payment. So the way that you would calculate this is you would take 180,000, so those are my sales, and then multiply that by 2% because that's how much you won't get now. So basically we're rewarding customers for paying us early so then we can have the cash early. So let's see what this ends up being. So 180,000, 180,000 times by 2% gives me 3,600. And I'll just put this in as a minus because I want all of the cash coming in as positive and then all of the cash coming out as negative. So now when I add the 1184 and subtract the 3,600, I end up with a negative 2416. And this is your net change in income from discount. So this is the opportunity cost. So in all of these types of questions, there's always an opportunity cost of not doing something, overdoing something. So if I'm in a negative, so by offering this discount, I'm actually going to lose $2,416. So in this case, I would say no, don't offer the discount because you'll end up losing money in the long run. So just to verbalize that, if negative, say no and don't do it. So in this case, don't offer the discount just based off of the quantitative analysis.